Federal Reserve Chair Jerome Powell announced a quarter-point cut to interest rates, but is that going to be enough to feel a difference? And are lower rates a good thing in this instance? Well, joining us now, certified financial planner Bobbi Rebell joins us to answer some of those questions. Hi there. Thanks for being with us this morning. What's your key takeaway from the Fed decision to lower rates?
Well, good morning, and thank you for having me. I think the key takeaway is this is about the trend, not the immediate impact of just this quarter point. But what we're hearing from the Fed is that they expect to have probably, and it's always data dependent, they always couch it, more cuts in this calendar year. And cumulatively, that could really move the needle for consumers on many levels, whether it's shopping, like you mentioned, consumer debt, but also when it comes to the housing market, taking out new loans for cars and so on. It could be very meaningful to a lot of people. And that's why we're seeing the markets really celebrating it today. We probably will have a better market today. We'll see.
Yeah, probably. The markets wanted, I know, a half point. The housing market, will it have really any impact on mortgage rates?
I think it will have psychological impact on people in the short term, and then longer term, it will have a real impact on rates. Remember, this is the Fed funds rate is what the Fed, it's a rate they set for the banks to lend each other's money, but it does set the tone for the mortgage market. So what happens is those banks, you may even see we've seen some lowering of mortgage rates already coming into this. So they take their cue from it, but it's not a literal connection. So you might see some easing of interest rates getting towards that direction. And then what happens is people might start shopping for houses because they're anticipating more affordable interest rates. And that could in and of itself become sort of a self-fulfilling virtuous cycle, which is what we like to see.
There are other areas, other sectors where these rates could make things more affordable?
Yeah, well, interest rates are tied to different benchmarks, and they do take their cue from the Fed funds rate. So we could see, for example, if you're looking for a car loan, you may see a little more wiggle room there. If you have debt on a credit card, in theory, those credit card companies should be lowering their rates. Sometimes they tend to drag their feet a little in the downward direction. We know they waste no time when it comes to raising rates. You might make a call to your credit card company and ask for a better rate because sometimes they do respond to that little bit of a nudge. But if you're taking out any kind of new loan, you might see better rates already. So that's something that could be very welcoming to consumers. And also, as is the goal of the Fed, can help the economy because more money in people's pockets can mean more money to spend. And that, of course, can help our economy.
Now, if you want to save, is this a time to try to lock in rates on things like CDs, or are we going to wait a little bit and see if the rate falls a little more?
Yeah, so Kieran, I'm so glad that you asked that question. It is probably a good time to lock in rates. Make sure that you are okay in terms of your liquidity, because when you lock in rates, you're also locking in that money. But it is a good time because even if they don't cut further rates, we really don't expect rates to go higher. So this is a good time. And remember, just as rates go down when they're loaning you money, the money that you put with the banks, that interest rate, your return will also go down. So you definitely want to think about locking in money if you can get a rate that makes sense for you and for your investing.
Bobbi Rebell, thanks for being here on Connecting America.